What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and if you have been around the channel for any length of time, you probably saw the title of this video that I just went long Treasuries, and I probably think that I'm going crazy, or some massive shift has happened in my macroeconomic outlook. So today, I'm going to break down for you, number one, why I went long Treasuries, and number two, how I went long Treasuries, and number three, why it might not be as crazy as you might think at first glance. Ready? Let's dive in. All right, guys, so there have been some big things happening in financial markets really over the last 2 weeks, week to 2 weeks. And one of the biggest things, most notable things, has been the rise in yields, the rise in bond yields. So for any of you who are new to bonds, yields and bond prices have an inverse relationship. So if I loan you $100 and I'm going to charge you interest, you owe me, let's say, $101 back. That interest rate is 1%, right? I could sell that debt, that piece of paper that says you owe me $101. I loaned you $100, but you owe me $101. If I then take that contract, that piece of paper, and I sell that to somebody else, so that now you owe them the money instead of owing me the money, and they can technically pay me whatever they want for the right to own that debt. And so if they pay me $101 for that, then their interest rate is 0%, because they paid $101 to me, and when you pay back the debt, they're going to get $101 from you. So they make $0. If they buy that debt from me for $102, their interest rate is negative, right? Because they're only going to get back $101 from you, but they paid $102 for that debt. And so they lose $1 on that deal. And so that's the relationship between the price of bonds, how much somebody's paying for the right to receive the payback of the debt, versus how much that debt is actually going to pay back on maturity, plus all the interest along the way. And so that's why interest rates and bond prices have an inverse relationship. So what we have seen historically is that during hard economic times, the Federal Reserve comes in and they suppress interest rates to kind of soften the blow to the economy. Because if interest rates are lower, it makes getting new debt easier, and you can roll over your old debt, and it's cheaper then to pay off your debt because the interest rate is lower, right? So your debt burden gets easier as interest rates go down. Now, how do they do this? They come in and they buy bonds. That's the way that they get interest rates low, is they come in and they're the buyer of bonds. And so they push up the price of bonds, which pushes down the interest rate. And so when you look at their balance sheet is, growing and growing and growing. And during times of economic crisis, it explodes upwards. That's because they step in and they make massive bond purchases. Now, normally, a lot of these bond purchases are U.S. government bonds. They're the Treasuries. So they're buying that debt that the government is issuing primarily. Over the last year, they've bought other forms of debt. They buy a lot of mortgage-backed securities still, and they've bought a lot of corporate debt. Now, they do this through these special purpose vehicles set up at the Treasury. They don't hold them on their own balance sheet specifically, but still they're coming in, they're creating money that goes to push up bond prices, to buy these bonds, to push prices up, which keeps the interest rates low. The reason they have to step in to do this is because during hard times, if nobody came in and kind of helped businesses out or helped governments out, then what could happen is that government or that business could become insolvent. And so the risk of a company not being able to pay back their debt means that I'm not willing to take 1% for an interest rate, but to loan money to that company, I would want maybe 10% or 15%, 20%, whatever. I'd want a much higher interest rate if I'm going to loan money to that company or that government, because there's a risk of them not paying me back. So for that heightened risk, I want a higher reward, higher interest rate. So in order to make sure that the economy doesn't price debt lower for the risk that the economy actually has, they step in and they pump a ton of money in to buy these bonds to keep the prices elevated, to keep the interest rates low. Now, one of the other reasons why somebody might want a high interest rate on the debt is that they're money that they're loaning to somebody is because of inflation expectations. Now, typically with modern economics, when you have growth, you have inflation expectations along with that growth. There's a big modern fear of deflation, and that inflation is viewed as good, and so so when you have growth, you also have inflation along with it. And so when inflation expectations go up, that means that everybody understands this. There's nobody that disagrees with this. Inflation means your dollars go less far than they did before. And so the purchasing power decreases. That means just things get more expensive. And so $100 or $1,000 will buy you less next year than it does this year if there's 1% or 2% inflation. That means as a lender, if you're going to lend somebody money, then you want that money to be returned to you, number one, to make somewhat of a profit, but you have to measure that with real purchasing power. And again, everybody understands this. This isn't some fringe economic view. This is classic traditional modern economics. You want the return on your money to have a real return. And so you're going to look at, normally people will look at the official inflation numbers, and they'll look at the amount that the debt is paying, the yield on the debt, and they'll say, hey, I want my debt to return a little bit, at least a little bit more than inflation. That way I'm not getting a negative return. Well, over the past year especially, widespread inflation expectations have been very low, but especially over the last couple of weeks, inflation expectations have been moving up. And so because of that, we've seen a spike in interest rates on bonds. Widespread investors are looking at the interest rate that bonds are paying them, the interest rate that they're holding these bonds, and they're saying, hey, you're paying me back, but I'm seeing inflation expectations start to go up. And so I don't want to hold this bond at 1% or 0.5% or whatever it's paying me if I expect that inflation is going to be more than that or much more than that. So investors are selling bonds. This means that the price of bonds is going down, but that's just one side of the equation. When the price of bonds goes down, the yield or the interest rate on bonds goes up. And so if you look, especially at Treasuries 2-year, 10-year, 30-year, the yield curve has been steepening recently, and interest rates have been going up. In fact, interest rates haven't been this high since February of last year, 2020, right before the massive amount of money went in to try and buy up a ton of bonds to push the yields down. And so they've been rising dramatically over the last couple of weeks and kind of slowly and steadily over the past couple of months. Now, you might be asking, if I'm saying and I'm noticing and everybody can see that people are selling bonds because they demand a higher interest rate on their debt in order to compensate for the inflation expectations, why would I go long treasuries right now? Why would I buy bonds? Because ultimately, that would mean that I expect that the bond prices go back up. But if you know me, I say inflation is going to happen, and it's going to happen a lot. And if inflation ticks up higher and higher and higher and higher, wouldn't that drive the price of bonds down lower and lower and lower? Normally, yes, but we don't live in normal market environments right now, do we? I made a video about this last week, I think, but right now, the government especially, and ultimately the economy as well, is insolvent. The debt to GDP ratio, the amount of debt that the US government has right now, the amount of interest that they're spending on it compared to their tax revenue and their current rate of borrowing and the expected spending that the government has planned for just even this next year for 2020, is in a place where the government cannot afford if rates go up. Because the only way the government continues to spend money is number one, taxes, and number two, borrowing. And there's not enough money in the economy. There's not enough capital in the economy to directly loan that to the government. And so the only way that they can borrow as much as they need to is from the Federal Reserve. Yes, it's indirect. It goes through banks, the primary dealers, but ultimately the Federal Reserve is the one who's creating the money that goes to the federal government to supply the capital needed for their increased borrowing. This means that if rates go up, the government cannot afford to roll over its old debt, because now that new debt becomes too expensive to pay the interest and pay the debt and pay the all the other expenses. And so in order for the government to stay solvent, they need the interest rates to stay low and move lower, because they're not just keeping pace with the amount of spending, they're actually increasing their spending. And so they need rates to move lower and lower and lower to kind of delay this inevitable end game as long as possible. So this means there really are only two choices here moving forward. Either the Federal Reserve steps up their bond buying and they, increase their purchases of treasuries to a much higher rate than they are right now, since they have to absorb now all of the selling from the rest of the economy. They have to increase their purchases to account for all that selling, to absorb all of that, and even more to account for what the government wants to spend. They either have to do that to push rates lower, or the government is insolvent and they They can't make their payments. And that's, I would be willing to bet that that doesn't happen. It's a possibility, but I'd be willing to bet it doesn't happen. This means that at some point soon, and I don't know if it's right now, kind of lucky I made my trade towards the beginning of the day here. So it was near the low of the day for bond prices. And, we rallied a little bit from there, bond prices. So yields came back down a little bit today. I don't know if this is the end of the bond sell-off. I'm not saying that, but the end is coming soon. If rates keep on going up, if bonds keep on getting sold off, the U.S. government insolvency comes front and center. And so at some point, the Fed has to step in and buy bonds, which will push the prices back up. So that's why I went long Treasuries today, because I'm just betting on the fact that the Fed is not going to allow the United States government to declare bankruptcy, basically. Now, a lot of you are probably wondering, what does this mean for gold? Because we know that if real interest rates are rising, then traditional economics says, hey, that's bad for gold. Well, number one, yes, that's kind of true, because gold is viewed in relationship to other currencies. And so if you can get a positive interest rate on currencies or sovereign debt, that gold doesn't pay an interest rate. And so compared to, traditional investors comparing the two, you're going to say, hey, that real yield instrument is a better investment than gold, which is a zero yield investment. When the opposite is true, when bonds are paying a negative real yield, that means gold is better, right? Because something that pays or takes zero is better than something that takes something, right? And so we saw, if you look today, even just on a small scale, we saw gold start to go up as soon as Treasuries started to go up as well, because rates the free market is trying to push rates higher. People are selling bonds because inflation is going up and inflation expectations are going up. Whatever the price of bonds does has no bearing on inflation. Inflation expectations has a bearing on bond prices, but not vice versa. And so the inflation and the inflation expectations will still be there, even if the Federal Reserve comes in and buys up all those bonds to push yields low. What that does is that pushes real yields further and further and further negative, because as inflation expectations rise, but the Fed keeps a cap on interest rates, that means that the real interest rate keeps on going more and more negative. So the current situation we have right now is rocket fuel for gold. We're in a position right now where really the only chance is a big increase in Federal Reserve printing to absorb all the bond selling, especially considering the fact that the federal government is planning a lot more spending this year than we've had, like last year, which was a record. And before that, we had, 2019 was record spending. And so this is only increasing. And so what the situation we're in right now is really rocket fuel for gold. There's a temporary time right now where yields are going up because bonds are selling off. Yes, you're going to see a sell-off in gold from that. But ultimately, long term, this is just giving a buying opportunity, because there's no way out. And the only other way out is literally default on U.S. government federal debt, Treasuries. And the odds of that happening, it's possible. It's possible. The odds of that happening, I think, are so unlikely that I'm willing to put a little bit of money on Treasuries. So that brings me to the second point. How did I actually make this play? Don't worry, very, very small amount of money. I love to use leverage in situations or trades like this, because when you use a lot of leverage, it allows you to put a very small amount of your capital into a play and still get somewhat of a decent impact on your portfolio if the trade goes your way. And so, and then if it doesn't go your way, it's a very insignificant impact on your portfolio. And so I didn't go out there and actually buy 10, 20, or 30-year Treasuries. I looked at the ETF, TLT, and I bought some calls on TLT. That's it. And so it's very, very easy to make little plays like this if you expect that something is going to go away. Go a certain way, instead of deploying a lot of capital into the main position that will basically have an insignificant difference on your portfolio if it goes the way you think it is. Using derivatives allows you to apply a lot of leverage, so you can deploy a very small amount of capital. Now, the risk, obviously, and the psychological risk in trading options is going to be that you make a trade and you start to get addicted to the high leverage and the high returns possible, and so you deploy too much capital into a trade because you could see the exponential returns. But it goes both ways, right? Leverage goes both ways. And so yes, you can have larger returns with leverage. You can also have larger losses with leverage. So you obviously have to know what you're doing. Be careful, do your own research. And this is not trading advice. But But that's just what I did. So I took a very small amount of my portfolio, put it into some calls on TLT, playing on a short-term move here that I expect at some point soon, if rates keep going up, Federal Reserve is going to step in and increase their Treasury purchases to a significant amount in order to compensate for the inflation expectations causing the market to sell these Treasuries. So that's all I have for you today. I really appreciate you guys, and thank you so much for watching. Have a great day.